Hey traders, this is Blake Morrow with Trader Summit, and I'm really excited about this particular show, and I'm glad you all are here because I'm bringing on Mr. Chris Weston, who he is
Hey,
the head of research at Pepperstone. Chris, good to see you, buddy.
yeah, it's good to see you, Blake. It's slightly different settings from what we usually banter about, but it's good to see you from the Casa Morrow.
Yeah, and that's the thing is I felt a little underdressed not having a jacket on right now, but this is a
Right.
cool setting for us to just kind of talk about the markets and actually, instead of just digging into trade setups, which I want everybody to make sure you all stick around because I will ask Chris about some of his best like trade ideas coming up. But I do need to mention this, Chris. You and I do the trade-off show hosted by Pepperstone, and we put on heck of a show, man. I think we give out some great ideas, and
Best in the market, mate. Best in the market.
yeah, hey, thanks for putting it all together. I think it's great banter, great ideas, great back and forth. But what I wanted to do today, before we get into kind of some of the trade setups, is as a trader, we formulate our ideas, our themes, framework of how we want to trade the markets, and then we like to figure out our timing on how to get into a particular trade. But what I've learned from you over the last several years of working with you is you're really good about building a framework, and I think a lot of it has to do with what you're looking in the fixed income markets, what's happening with yields, and what central banks are doing. Can you give us as traders a little bit of your process on how you develop a framework, if you will, on how you want to attack the markets? How do you go about that?
Well, I think there's different. I mean, it comes down to your strategy at the end of the day. I mean, if you're trading a momentum strategy in FX markets or any asset or instrument, you just got to identify things that are strong. And if you look at Nat Gas, for example, today, I don't have a chart up in front of me right now, but we've seen this like really strong consolidation, this compression in volatility. The Bollinger Bands have come right in, and we then saw a range expansion through the highs. And the rate of change has picked up. Breakouts happen, bull trends, momentum moves happen after that situation. We don't know how long they're going to last, but we've got to try and hold them, and you've got to try and hold them and cut the losses as quickly as you can. So that's a momentum type strategy, and I run that quite across all different markets, but certainly in the FX markets, you get less opportunities if you're trading off sort of 4-hour daily charts because mean FX is so mean reverting, isn't it? You don't get those longer term moves. I mean, we've had a couple recently. I mean, obviously the yen has been one that a lot of people will know and use as a case study for holding those trades. The other one, of course, if you're using these yield spreads in fixed income markets, then it's more about really understanding what is driving a currency, and if you can see that there's a really strong sensitivity between relative yield differentials, then that those currencies are very much a potential central bank divergence play, and that the market is going to be very sensitive to changes in growth and inflation data and relative economic performance. You still have to then take a view about where those yields are going to go, which sort of feeds into the idea you might as well just look at the FX markets and trade price. But at least then if it's becoming a bit more of a cyclical currency, and you can use that really effectively in your risk management strategy because you can understand, if the market's working on this, and the euro dollar, for example, is very sensitive to, the difference between, the German 10-year Bund and the US Treasury 10-year maturity, then that you've got to keep an eye on specific data points because those yields are going to widen or contract, and that's going to have a big impact on the FX market. So if the market's sensitive to those data points, then you know that you've got to manage that position ahead of that situation. So but I think with things, when when you see that clear divergence taking place between central bank policy, obviously we saw that between the Fed and the Bank of Japan last year, and what you end up seeing then is these trends developing because policy between central banks is becoming wider, and you take a view that those yields are going to continue widening, and typically the currency will follow.
You know, Chris, you said something interesting, because once you develop that framework of how you want to attack the market, you focus a lot on price action. I fancy myself a bit of a technician, but after working with you for the last couple of years, you're really great at looking at charts. But specifically, what do you look at from a price action standpoint when you're looking to actually enter and exit a market as well?
Well, I mean, yeah, again, it comes down to the strategy. I mean, I do like to run mean reversion strategies as well. And I think if with things like momentum and mean reversion, where prices ended up in that candle is obviously so important. It's obviously a roadmap of supply and demand. And I think if we take FX markets in its purest form, I mean, it is just this aggregation of cross capital flows and different types of flows, exporters, reserve managers for central banks, real money accounts, speculators, leverage hedge funds, and the world is very opaque. It's not like unless you're a buy side fund, pension fund who can get access to a lot of the sell side data, the flow data, who's doing what and where and when. It's very difficult to understand who's moving capital around. Because it's OTC, it's a very opaque world. And really, in that situation, price is true. Price aggregates all of those different flows into one situation. And I think it tells you a lot about people's propensity, or the market's propensity to keep moving in one direction. And it tells you your risk. So, price action in that situation aggregates all of those behaviors that are taking place between all these key players. And it obviously it's not predictive, but it does. And I'd love to hear your take on that, whether you do think it's predictive. I don't. But what it does is it tells me about the risk of something going in a certain direction, where the skew of risk is going to go, and how I want to manage that position. So obviously we don't know the future. If we did, we'd be insider trading. But what it does do is it helps you with your risk reward profile, and where it aggregates the flow, and it gives me a sense of what the market's feeling and where the market may want to go.
Yeah, and I guess maybe I can add to that as far as price action goes for me, is just looking at certain levels, and I know they've been respected. And once they violate those levels, that gives you that clear indication that it is breaking out, or it has respected it. And as long as you can get some sort of confluence of different technical indicators happening at the same time, that tends to help me out. But it's interesting, as you look at this aggregate of price, as you called, I tend to agree. FX in its most purest form is a very, very big, deep, extremely liquid market. And when the trends develop, they tend to be pretty long standing. So let me ask you this for yourself, and I know you probably tackle the markets differently based on what conditions that we're dealing with. But what do you fancy yourself as a trader? Do you scalp the market more, or do you find yourself more swing trading? Or do you take positions, and not necessarily in FX either, but in markets in general? What do you gravitate to as a personal preference as a trader?
Yeah, it's a great question. I mean, if I didn't have a full-time job where I'm actually looking at the markets all the time, I mean, I probably would love to do some scalping work, but I'm just not in a position to be doing that. I've got other things going on at this time, so I'm not a full-time trader. I do trade, but I'm helping clients manage risk. But I like to trade because I think I'm pretty good at it. I make money, and it also helps me in terms of the strategy job, just feel the markets a lot better. When you're in there, you're putting capital to work. You just feel the rhythm and the pulse of the market a lot better. But the way that I'm working on momentum and mean reversion is more. I'm sort of trading 4-hour charts, daily charts. I'm in the market for a day. I could be in the market for a week. If you've got one of those trades that's working, and your job is really just to stay in it and extract as much juice out of the trade as possible. I could be in there for a couple of weeks. I'm obviously paying swaps and bits and pieces, but I don't really care if the trade's working and going up. My job is to sustain that trade as long as possible. And I think for that situation, I'd use a very much a systematic exit strategy to get out of those trades. I think it's probably the only way that you can really hold those positions unemotionally. So you just use something very simple like price holding the 5-day exponential moving average. Sounds really simple, but it works a lot of the time, or even a 3-8 day exponential crossover, or even using a trailing ATR. All of this stuff helps to hold that position. You just don't know if it's going to keep going, right? You just don't know. No one knows.
Right.
But you've got to capture that move if it does. And I think the human emotion side of things becomes very difficult for a lot of traders. And so I think becoming systematic and holding quite well. But I think just to answer your question, I'm not trading a lot, probably average sort of 7 to 10 trades a week. But that's because my whole time the time frames that I'm looking at are sort of longer term time frames as opposed to 15-30 minute trades.
I would say that you and I probably fit a very similar mold because of our respective job duties on what we do. And so with that being said, as you're swing trading the market, where do you know, because I know for me personally, I know the way I feel when I'm too large and I start to get nervous. Do you ever get in situations like that where you're trading the market and you get to a point where you're like, I actually have to pare back my size because I got too big? And when does that happen? Because like for me, and I'm going to talk to you as a trader, Chris. There's probably a few situations each month, I would say, if I had to put my finger on it, I'd say 1 to 4 great trade opportunities where I tend to put more size on to capitalize on a move that I feel very confident about. But I know that size can kind of bite me in the butt a little bit because I get a little nervous and I might, mismanage a little bit based just on P&L versus what I know I should be doing. Do you have like a threshold where you're like, and do you ever breach it as a trader? And do you ever get in situations like that?
What's the saying they say? Size opens eyes. I think Larry McDonald
That's a good one. I've never heard that, Chris, but that's a great one. I'm gonna use that.
I actually think it's a bit of both. Actually, I think there's quite a lot of times where I feel like my position size is too small. My position size is always like a reflection of the risk that I'm taking on, and obviously the size of my accounts. But I like to certainly with the momentum strategies, and it's not necessarily you can call it a trend following system, but it's certainly a momentum strategy buying breakouts and holding. I will start off quite small. I will start off and I'll layer into trades that are doing well. I guess when something's had a decent move, it does feel a bit. The position size can feel a bit toppy at the time, but as I said. That's when if it's had a move and I'm adding to positions on top of that, the stop loss, the systematic stop loss will get me out of trades. I might take a bit off the table. I might take the whole lot off the table. But generally speaking, at the start, I'm pretty small and I'm building onto those winning trades. So if I lose small. If by the end of it, I've got a large winning position, but the smaller ones might be out of the money. I typically. It's not often that I'm worried about having too big a position over a risk event or some sort of issue, because generally speaking, I'm starting small and adding into that situation, and that small position, if it now becomes a big one, that small position, that first position is now nicely in the money. So that's typically I don't feel that, but I can understand where you're coming from this. So I'd ask you in the same situation, if you are feeling pretty large, right? So we've got a CPI print coming up next week. What's your train of thought over that? I mean, this is the art of risk management, right? So the first thing I would do I'd be looking at things like the options market. I'll be looking at implied vols over the market and sensing, is the market anticipating a big move over this announcement? And what does, if they are expecting a big move because the break even rates on a straddle, for example, are significantly wider than what they usually do. Well, I'm saying the market expects movement. Why are they expecting movement? I like to know why. A lot of technicians don't really care, but I want to know why. Well, because this is the key data point that could mean the Fed look to ease policy in September, blah blah blah. So if the market's obviously sensitive to that, we were expecting a big move. I'm going to be saying to myself, I've got my systematic stop in place, but in other strategies, I might say to myself, well, where are the risks? Is the risk two-way? Fine, I want to take a bit off the table, maybe take the full position off. I might be happy to hold it, but I'm using the market to tell me if they think it's a volatility event, and then telling me the extent of the move, and using that to help me manage risk. But yeah, what would you do if you've got a big position there and you're feeling a bit large, as you say, and you've got these big data points around them? What are you doing?
Well, that's an interesting question, because I could tell you in more real time what I've been doing is just actually starting over the last couple of days, off the heels of our trade-off show, is I was selling dollars over the last 24 hours, and it's worked well into the money. And what I'm hoping is, and this is what I try to do against every major event that is going to be a volatility event, such as CPI next week, is I try to get enough run rate in front of me, so I've got a cushion in that position. So if like, let's say I'm long the Kiwi dollar, which I happen to be as of today, I'm up, let's just say all the technical levels complete, and I've gotten myself a situation where I'm up, let's say 60 or 80 pips going into the data. Then I know that obviously I'm looking for weak data, because if I get weak CPI, it's going to continue to run. But that's what I try to do, is I try to pre-position myself on what I think the outcome is going to be, based on, all the analysis and, reading every single one of Chris Weston's tweets. Like, getting myself into getting myself in a position where hopefully it's if the data goes my way, because it is, at the end of the day, it's a bit of a crapshoot. Even though you can read everything you want to read, the market, is leaning in one direction, and hopefully you get the data going in your direction, and then I pare back my position ahead of data, because it's if you don't, it could end up hurting. So that's how I try to pre-position myself. I try to get ahead of the move as we're going into data. But doesn't always work that way, and it doesn't always work the way you plan. Speaking of which, and that probably brings up another question. How many of your trades, and then I'm going to go into what you're looking at like now, but how many of your trades do you really plan out, and how many of them just kind of pop up? Like, I try to plan a lot of my trades, but I'll be the first one to admit things happen throughout the course of the day, and I'm like, wow, that setup, it fits my mold on what I like to do. I'm going to take advantage of it. But how often do you plan out your trades?
I guess the good thing for you is I know that you incorporate patterns quite a lot in, and obviously the behavioural side of trading into yours. And I guess if we cover this a lot in the trade-off, with the setup. So if you've got a setup on the radar, you can plan that stuff, right? You can have it, you can get your triggers, but you can be prepared. Like, what is the volatility? I know my position size going into it. I just now need the market to come to me, give me that confidence to take that position. So you can plan for that stuff pretty well, I reckon. Am I right?
Yeah, well, probably not as good as you, because I think you use a lot. One of the benefits, I think, of being a Pepperstone client and having you access to what you do is having some of the tools in your toolbox that you use. So I have some tools, maybe not as exclusive as yours.
Well, I think the first thing I do in the morning is I'm coming in. Well, first thing you do is you check your iPhone to see your positions, don't you? Because it's that period of not knowing it, just like your most vulnerable point in your life. But I want to see what's moving. Yeah, movement is everything, right? So I'm finding out things. If obviously with my positions, I'm managing those. But then when you're looking at new opportunities, you're looking at things that are moving. You're going through the charts. You're looking at setups. You're looking at the flow. You've seen the news. Generally, the news will reflect the things that are going to be moving. And then it's a question of looking at it, what does it look like? What's the shape? What's the feel? And then you go through your sort of process that you've got. But you're just really being drawn to different types of movements. And obviously assessing what that looks like, and going through the step-by-step process that you have. I mean, I like to have a set of rules, like a lot of people, try and stick to those, and that keeps me in the trades that I want to be in, and out of the trades that I shouldn't be, to be fair. But I think I think the bottom line is for me, it's important to have a strategy, whether that's momentum, whether it's trend following, whether it's patterns, whether it's mean reversion, whatever that is, and that will dictate the set of rules that you're going to be taking trades by. What are the indicators that you're using? What do they look like? Do they marry up with that? And I think if you've got that strategy, that's when you can go through the charts, you can go through the news, and you can see those setups and have those high probability trades.
Very good. Chris, I know, well, first of all, we're on opposite sides of the earth. So doing these shows, doing this interview, it's great. It's like early in the morning for him. It's late in the evening for me, but I'm glad that we get an opportunity to do this. And I appreciate you being here. But I want to ask you this, the trade-off, I think we do a really great job, getting people prepared for the week, some of the big things that might be coming that week. But I'm going to ask you to look out just a little bit beyond that, not the rest of 2024, but here we are. We have equity markets at highs. We're near all-time highs again. We were looking at European markets just a couple of days ago, breaking new highs now. Where do you think? Yeah, they are to just continue to rip. Let me ask you this though: where's the risk right now in the market, in your view, in the coming months ahead? Because obviously we're going election cycles for a lot of different countries, specifically here in the U.S. You got a lot of chatter on which way central banks might go, specifically the Fed. I think that's the biggest variable right now. But looking ahead, where do you see the biggest risks in the market, and what are you tuned into right now?
When you say the biggest risk, we're looking at the things that could cause volatility, or where the skew of risk is in markets.
Maybe what could cause some volatility, because the volatility is obviously really low. So what could jump out on the horizon as a potential pitfall the market might come across?
Yeah, it's a good question. I think. I still think that the biggest one would be something to cause a lasting move. It has to come from something to do with a central bank, right? And I think it's a low probability myself, but if we were to see, obviously the key one, which everyone talks about, is this idea that we could see, inflation, not services inflation, super core inflation, making a bit of a steady climb back up that would really, the 2 rate cuts that are now priced into swaps for the end of the year in the US, that comes out. It actually looks like it's probably going the other way, and that the Fed will look to cut. I'm not sure if they cut September, which is being priced in because that's too soon to the election. But I think the biggest risk would be inflation lifting up again, and the economy still being pretty hard driven by consumption, and the right tail risk gets realised, and that is that the rate cuts come out of the market because of further inflation concerns. That would take real rates, 10-year real rates, into sort of 250, 10-year treasuries back above where they were in October. I think that would be the thing that caused the proper risk-off move and a lasting risk move, and we'd see a lot of tech stocks, going into proper drawdown. Do I think that's going to happen? I don't know, but that would be the big risk. I mean, the geopolitical angle is still bubbling along. Market seems a lot more comfortable with that situation now, but that could resurface. The obvious one, which we're going to talk about at length going forward, is obviously the US election. Is Trump going to say something that's going to cause the lasting risk-off move? It doesn't feel like that's going to be the case, because a lot of his policy, there's a lot of policies that still need to fully come out, and the market isn't trading the election yet. It's still way too early, isn't it? But is it really going to cause a risk-off move? Maybe. I mean, a 10% sweeping tariff on imports is not great, and there's other aspects, and it depends what happens with his choice of Treasury Secretary, because we talked about it yesterday in the trade-off. There's that Robert Lighthizer, who's a bit of a lunatic, and I think the combination of the combination of him and Trump, if he was to get in, I'm not sure if that's going to be the case, but he's talking about, they both massively want to get the US dollar down. Could we see a Plaza Accord too? That would send shockwaves down the market. So, I think we know what's happening with Trump. So I suspect it's not going to be a massive volatility event. But I don't know. I think with traders, we talk about all the time, we've got to have an open mind. And So I feel like it has the potential to be volatility. I don't think it will, but it has the potential. So we've got to recognise the signs, wait for those policies to come out, see if the market actually acts on them, and be prepared to react to those. So yeah, probably the inflation risk is the biggest one right now. But yeah, I suspect that inflation will grind lower down towards target next year. But I think people who've been trying to predict rates and inflation have got it so wrong. I mean, the market's all over the place, isn't it? So
It is.
yeah. What about you? Where do you see that?
Oh, I don't know. I probably fall in line with you. I think inflation is going to be stickier globally, and I think it's going to be more difficult than the market predicts right now. So I do think rate cuts are going to the expectations are going to come out by year end. I think we're going to get to the end of the year, and there might not have been any cuts at all. And so
I don't think that's too bad. I mean, I've said this before. I don't think no rate cuts is bad. I think the market can absorb no rate cuts as long as the growth is there. If stagflation was to properly manifest, we did see recession risks rising. I mean, a recession's some way off if it happens at all. But if we were to see the market saying, hang on a second, we are seeing a properly cooling labour market, we are seeing growth starting to fall. And that's not going to happen anytime soon. But if it was, and that inflation stays higher and the market starts trading stagflation, I think that's the risk, isn't it? But yeah, it's not going to happen overnight if it happens at all.
And the other thing about jobs, I try, especially focus more here on the U.S. and I'm not so sure around everywhere else. The quality of jobs that are abundant right now they're not quite there. So those would be the first ones to be cut. So if you had a job as a engineer or maybe a secretary somewhere, and you had to pick up a couple of jobs to make up that income because you lost that job somewhere down the line. The unfortunate thing is I think that the quality of jobs out there that could be cut quite aggressively. We saw the weekly unemployment claims come out today, and they were substantially higher than expected, not beyond something we've seen over the last couple of years, but the jolt in those was a little alarming. I think the dollar responded appropriately. You had and then you're seeing ISM not looking so hot. So I think there's things that, as you pointed out, maybe the economy does slow down a little bit, and inflation stays sticky, and that might be something that takes its toll on the market. But Chris, you and I, we work together all the time, and I really enjoy our conversations that we have on the trade-off. But I have to say that as somebody that gets an opportunity to work with you, I have the benefit of doing that. Tell us and tell the traders what it's like to be a Pepperstone client and what benefits they have as far, because you said something earlier, like I work with my clients as far as risk management goes. What are the benefits of being with Pepperstone? Obviously having access to you, but what else do traders get there?
Oh, I don't want to turn this into an outrageous sales pitch.
No, but I think it's important though. I think it's important because you are a real genuine, great. You bring a lot of knowledge to the market and a lot of experience to your clients.
I'm humbled, Blake. I'm humbled. I mean, I guess it really depends on where you are in the world, because regulatory issues are unkind to a lot of US traders, aren't they? So
they are.
But yeah, I mean, with Pepperstone, we offer a range of platforms: TradingView, your Meta traders, your C traders, and we've got our own proprietary trading platform as well. Fantastic liquidity. I think we've probably got best in class liquidity, top of book. So for people that's really, really important for me, because if you're trading, a lot of brokers will offer you really, really very tight spreads, but they're not necessarily realistic, because if you want to do something in something than 0.3 of a lot or something like that, then they'll slip you down the book. So I think what brokers show you at top of book, I think, is really, really important, because a lot of people don't see that top of book liquidity effectively, and that can cost you. The cost of trade is the spreads and the cost of trade will impact your performance over time. So I think that's really important. Having good liquidity at the broker level is really important. Range of markets. We've now got all the cryptos, obviously massive range of FX markets, forwards. We just brought out 24-hour shares so people can trade US equities as CFD 24 hours, which is quite unique even in the pre and post market hours. And we've got a range of shares, different indices, gold, all of the. So I think the range of markets is there. We also do spread betting for UK clients as well. Customer service, I think it's really important when it's one of those things you don't know you need until you get it. So I think all those factors. But I think the other factor as well, Blake, is regulation. While I'm here, regulations. We take our commitment very seriously. We're regulated in 7 different jurisdictions. So I think that's a really important situation with broker in terms of trusting.
Absolutely. Well, Chris, down below in the link down below, you'll find a link to our latest trade-off show. I'll make sure that that's there. But I want to thank you for spending time with us here at the Traders Summit. I really appreciate you. Like I said, I really enjoy working with you every week. If you don't catch a trade-off every week, make sure you do, because it's a great collaboration that we've been doing for quite some time. But Chris, what's the best way for people to follow you on social media?
I'm pretty old school, to be honest. So I'm not a sort of an avid TikTok guy or anything like that. But just Chris _ Weston, Chris Weston @ Pepperstone PS, I think it is. Chris Weston _ PS, is the Twitter handle there. You go there and you can reach out and say hello. All
right. Well, Chris, thank you so much for spending your time here on the Traders Summit, and let's make sure we do this again sometime soon.
Like to, mate. And I want to thank you as well, Blake, because you keep banging about how amazing I am, but you're the one who's he gets up every week. You come with some fantastic ideas, different perspectives. So no, we want to thank you at Pepperstone for equally just giving it your all and some fantastic insights and opening up to your community as well. So thank you.
Much appreciated. All right. Well, have a great one, everybody. And if you liked what you heard here, make sure you give Chris a big thumbs up. Jump down in the comments down below if you have some views that you wanted to share with them as well. All right. So thank you for tuning in, and we'll catch you next time.
Good on you, mate. Thanks, everyone.
Hey, traders. Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.